This is a question called Donna. It was question 17, so a 25-mark essay from the paper 1 from 2022, all about investor ratios. So we're going to have a quick recap of the investor ratios before we plough on with the question. So investor ratios. First one we've got here is dividend yield. You take the dividend per share and you divide that by the market price per share, multiply it by 100 because it's expressed as a percentage. Don't forget that you either need to do both of them in pence or both of them in pounds. Otherwise you will get the wrong answer. You'll get some very strange figures. So this shows the dividend received related back to the market value of the share. So it's the shareholders' annual dividend expressed as a percentage of the current market price or the market price that you've been given. That's one thing to be aware of. How up to date is that market price? Because in a volatile market, it could change very much from one day to another. Obviously, the higher the percentage, the better. That shows that you're getting a higher return on the investment, excuse me, on the value of your investment at the moment. It's an inadequate measure, though, as it concentrates on profits that have actually been paid out as dividends and ignores total profits. So the company may be paying dividends from retained earnings, which is not sustainable in the long term. So it might be an artificially high figure, or it might be the other way around, that the company is actually retaining profits in the company, retaining cash rather than pay it out as dividends in order to reinvest and expand the business. Okay, the next one we've got is earnings per share. This is where we take the profit for the year after interest and tax and divide it by the number of issued ordinary shares. Now, this measures the amount of profit earned by each share after tax, and it's usually expressed in pence. Now, this can be quite a useful indicator from one year to the next for the same company, but it's not very good for comparing companies with one another because all companies have a different number of ordinary shares in circulation. So it's kind of meaningless, really, but it's quite useful to help spot trends within a company from one year to another. Number 3, we've got dividend cover. This is the profit for the year, again, after interest and tax, that bottom figure in the income statement, and we're dividing it by the ordinary share dividends paid, the total amount paid. That's all the dividends in the year that you will find in the statement of changes in equity. So this is the number of times that the company could afford to pay the current dividends from the current year's profits. A figure below 1 indicates that they would have to dip into retained earnings to pay the dividend. So if your dividend cover is exactly 1, then you've paid out all the profit for the year as dividends. Now, obviously, that's not really sustainable. Most companies would try and retain some profit within the company for reinvestment. So a dividend cover of 2 means that 50% of the profits have been paid out as dividends and 50% are retained or reinvested. Dividend cover of 7 means 1/7 has been paid out as dividends and 6/7 have been retained. So the higher the figure, the more profits are being retained in the company, which isn't good in the short term if you're looking for income, but in the long term it is good. It suggests that the company is reinvesting. Either that or they've run out of cash. So you need to look at the statement of financial position or the statement of cash flows and see what that situation is. Okay, the next one we've got is price earnings ratio. This is where the current market price per share goes on the top, earnings per share go on the bottom. So this is comparing the share's market price to its earnings, its profit after tax, how many times the share would have to earn that level of profit to cover its cost. So, for example, if we've got a share with a market value of £10 and its earnings per share are £1, that means that the share costs 10 times the last reported earnings of that share. Now, what that means in a nutshell is that it would take, if nothing changed, it would take 10 years to repay that investment from its earnings. Now, that's not the same as dividends, remember. So it gives an indication of how expensive a share is. So a higher ratio could suggest that the share price has been pushed up in anticipation of an improvement in earnings. So you've got high profit forecast, news of a merger, breakthrough into some new area of research, something that's given a bit of excitement in the market. So the share is now expensive. If you've got a lower ratio, though, that suggests that investors do not expect much growth in earnings in the foreseeable future. So a higher ratio means that this share is expensive. A lower ratio means that it's cheap. Okay, one more we've got to look at is interest cover. This is where we take the operating profit, this is before tax and interest, and divide it by the interest payable, the finance cost. So this shows how affordable the current level of debt is to the company. So this is closely linked to gearing. It's how many times the company could afford to pay its interest charges from operating profits. And really, it's the higher, the better there. So the higher the interest cover, the better, or the more stable the company is, potentially the less reliant on debt it is. Okay, other calculations that you might be asked to do or need to do to find the dividend per share, take the total dividends paid, that's the number that's in the statement of changes in equity, and divide that by the number of shares. Now, be careful here if they're not £1 ordinary shares. If they're 20p shares, you get 5 to the pound, so multiply up the value by 5. If they're 50p shares, you get 2 to the pound, so multiply the value of the share capital, ordinary share capital, by 2 in that case. Sometimes we can calculate a missing figure from the other ratio, so we can start rearranging the formulae. So earnings per share multiplied by the price earnings ratio will give us the market price per share. And that did actually come up in the 2019 exam. I think that was a question called Hannah. Right, let's have a look then at the question. So this is Donna, as I said, from June 2022. She's retired and she's received a lump sum of £50,000 that she wishes to invest in shares. She needs a return from this investment to help fund her retirement. She's researched companies of which she already had knowledge as a customer, and she has 2 companies as her preferred choice. Donna has provided you with the following information based on the last 3 years trading for each company. Okay, so she got £50,000. It's her retirement fund, so she probably can't afford to lose it. She wants a return, she wants income, so return is profit. In this case, income. And she's got 2 companies she's come up with. She's a customer of both of them, and she's given you 3 years worth of trading figures, so we can help. That will help us to spot some trends. Okay, so this is the financial information. We've got PIC PLC and we've got Barnard PLC, and you can see there we've got earnings per share, we've got dividend cover, we've got market price per share at the year end, and we've got dividend yield. So we can kind of glance over those. We can see that for PIC PLC, its earnings per share seem to have peaked in 2021, gone back down again in 2022, whereas with Barnard, it's risen from 5p to 9p to 16p. So showing some strong growth there in earnings per share. Dividend cover, much lower for PIC. It was 6.7 times in 2020, but that seems to have dipped to 2.4 times in the last couple of years. That means that they're paying roughly half their profits out as dividends and retaining the other half. Whereas with Barnard, it looks like they're retaining more profits, so that would indicate growth. Market price per share, £1.40 for PIC in 2020. That's risen to £2.20 in 2021 and then fallen back to £2 in 2022. Whereas Barnard PLC has shown strong growth throughout the 3 years, 60p to 125 to £1.40. Dividend yield, PIC PLC 1.5% in 2020, but that's when their dividend cover was 6.7 times, so they were only paying out 1/7 of their profits roughly as dividends. That's gone up to 3% in 2021, 2.5% in 2022. Now, all of those figures are higher than Barnard's. Barnard's has gone from 1.5 to 1.4 to 1.6, so pretty low. Now, remember that dividend yield is going to give you an indicator of the amount of income you're likely to receive. So quite an important indicator for Donna because that's what she's after from her investment. Okay, so we've got some more information now. It says that PIC PLC is a social media company which owns a number of popular websites and apps. It's been trading for 9 years and has very little debt. So very little debt is a good thing, means that gearing is low and risk should be lower. The company has a small head office since most of its staff work from home, which keeps costs to a minimum. That's good for profits. PIC PLC sells adverts on its websites and apps. There have been rumours that it tracks the data of its users and sells this to advertisers, which would breach data protection laws. That doesn't sound very good. Bad for brand reputation, ultimately profit and investment. This has created some concerns about its ethical stance as a company, particularly as many teenagers use the sites. The government has the ability to issue multi-million-pound fines for companies found guilty of breaching these rules. And obviously, if they get themselves landed with a multi-million-pound fine, it's going to be very bad for their profits and therefore for Donna's income levels. Barnard PLC, on the other hand, is a supermarket chain. It's an established company which has been trading for around 50 years, got supermarkets in most UK cities. They own a large amount of land in key locations around the country. Most of its stores are owned by Barnard PLC, although there are a large number of mortgages secured on these properties. It doesn't tell us how much those mortgages are, just a large number. It doesn't really tell us about the magnitude of them, how big they are. But that could be an indicator that gearing is potentially quite high. Although the fact that they're linked to properties means that there's some security there. It sources as many fair trade products as possible and has a policy of dealing with suppliers and other stakeholders who behave ethically. So that obviously is going to be good for their brand reputation. Up both of these companies using the information that's being provided and bringing our own knowledge in about the industries that these businesses operate in. So we've got to give a balanced point of view, say what's good and bad about it. Don't forget that we're trying to weigh up whether Donna should be investing in these companies. So we're trying to find the one that's potentially going to be safest for her £50,000, but also going to provide her with the most amount of income. Okay, so first of all, we've got to identify the problem. We've got investor ratios for 2 companies for 3 financial years. So to summarise the information we've got there, PIC PLC is reasonably well established, been going for 9 years. It's not brand new. It's a social media company with a number of popular websites. It's got a small head office. Most staff work from home. So as I said before, that's going to keep the costs low. We've got the rumours of this data protection breach. So those fines potentially are going to reduce profit. And we've got concerns over ethical stance, so that could reduce sales. Barnard PLC, though, well established, large amounts of land. Most stores are owned, large number of mortgages, though, so could there be some high gearing, maybe some potential risk there. Fair trade products and dealing ethically with people may well reduce their profit margins, but that could attract customers and investors. Donna's got £50,000 to invest and she wants to return to fund her retirement, and that could be from income and or capital growth. She's a customer of both the businesses, and then as I said, we're going to evaluate both of them from her perspective as a potential investor. Okay, and the biggest thing of all, must make sure that we give them a recommendation at the end, so how she should invest her savings. Should she put it all in PIC? Should she put it all in Barnard? Should she maybe split her investment across the 2? Or, in extreme cases, maybe she would be best advised not to invest in either of them, to put her money in a building society or a bank. So basic application marks, this is where we're going to get the AO2, maximum of 5 marks there, but without doing the AO2, you've got nothing to hang the AO3 on. So you really need to be aiming to achieve at least 5 AO2 marks with any of these essays. So how many shares can she afford to buy in each company? So it's just a case of taking the £50,000 and dividing it by the current market price, although one limitation there is how up to date is this market price, what's happened since those figures were published. So she can afford to buy 25,000 shares in PIC and she can get 35,714 shares in Barnard. Well, that doesn't really tell us a great deal other than she can buy more in Barnard than she can in PIC. Let's look at what level of income Donna could get from each of these investments. Use the dividend yield for that one. So 50,000 at 2.5% will give her £1,250. Barnard, 1.6% will give her £800. Now, both of those, with the recent interest rate rises, are well below what she could get if she put that money just in a bank, or possibly even in premium, in premium bonds. So it does beg the question: is it going to be worth the risk? More AO2 marks available for making basic comments on the ratios we've been given. So talking about the earnings per share fluctuating for PIC, whereas it's high and it's growing for Barnard. Dividend cover seems to be declining for PIC, it's growing for Barnard. Don't just say they're higher or lower, that doesn't really tell us anything. Are they improving? Are they deteriorating? Is it increasing, decreasing? Is it a good thing? Is it a bad thing? The share price fluctuates for PIC. It's got overall growth of 60p, but it's doubled for Barnard. So that suggests it's doing well. So carrying on with basic comments, more AO2 marks here. PIC has got very little debt, which means more profit for shareholders. It's an online business model with a small head office, so that keeps the costs lower. Its poor ethical stance, however, could lead to a consumer backlash, whether or not the rumours are true. And the value of shares could drop if consumers move to alternative platforms. So if consumers go to other providers of these apps, then that means a loss in business and therefore profits for PIC. Barnard, we've got mortgages, so we have to pay interest before we can pay dividends. So that will affect Donna's dividend payout. Bricks and mortar means higher costs. So they've got buildings rather than an online presence. So that means less profits to pay dividends from. Although the good ethical stance could mean good publicity in the future. And dividend cover is growing, meaning that more profits are being retained. So that could be that they are investing, holding back paying dividends in order to invest in more supermarkets, or it could just be that they've run out of cash. We haven't really got enough information to be able to establish which one it is. Strong market price, though, suggests investor confidence, so that is generally a good thing. Okay, analysis and evaluation. I'm not going to go back through this again. Hopefully you've printed yourselves off a copy of this question, but take each of those ratios and ask yourself, what is the trend? How does it compare to previous years? Which company is performing better on individual ratios and overall as a whole? Are there any figures that are unusual or unsustainable? So dividend cover is one to look at there. What will that mean in the short term? So dividend cover, a low figure means good income levels, but it doesn't mean very good prospects in the future because they're not retaining earnings, whereas maybe a higher dividend cover, not so good for income, might be better in the long term. Which is safer? Which of those companies is safer? So what else do we know about the companies? So PIC is relatively new. It's got a poor reputation for those data breaches, so we could talk about what impact those fines would have on profits. It owns a head office, but it's got no high street presence. So no debt secured suggests low gearing or no gearing, although we don't know that for a fact. So that could lead to higher profits. Barnard is well established. It's got good brand reputation, behaves ethically, and it owns property, but it does have debt. So gearing could be high. Again, we just don't know what happens if the interest rates rise. That will lead to lower profits and therefore lower dividend income for Donna. Could we sell land to generate cash, maybe repay some of the mortgages? I don't know whether the land they're proposing to build on it doesn't really tell us much about that, or whether it's spare land where perhaps they've been refused planning permission for another supermarket. We don't know, but perhaps any surplus land could be sold to repay mortgages. It's just an idea. Okay, problems and limitations. So we've got to identify any limitations to the data and any additional information that would be useful in making an informed decisions. I think the obvious ones here, the fact that ratios are based on historical information and do not show the current position. Even the market price is likely to be out of date by the time we're dealing with it. So the year-end accounts are already several months old by the time they're published. And just because something's performed well in the past doesn't mean it's going to do well in the future. Okay, so we don't know the current market price of the shares, I've already mentioned. Interest cover, gearing, we don't know what those figures are. What are the industry averages? How well do these businesses compare with their respective industry averages? And that will be different, obviously, for both of them because they're operating in different industries. What do the actual accounts look like? Is there a danger they could have been window dressed? So this is trying to make them look better than they really are towards the year end, so collecting money in quickly from customers and paying suppliers, that sort of thing. And what are the gearing levels? And the other thing about ratios is it doesn't consider, or they don't consider, non-financial information such as the company's longer term plans, its strategy, its management experience, sources of finance, loyal workforce, all that kind of stuff, and qualitative data. What are the current market conditions in each industry? You know, is there a lot of competition? How are supermarkets doing? How is, what's happening in regard to competition with PIC PLC? We don't really know a great deal about that. And then finally, evaluation. So could there be better investment opportunities elsewhere? Should Donna consider splitting her investment between the two companies to spread the risk? We don't know what Donna's attitude to risk is. Presumably she can't afford to lose that 50,000 that's going to help fund her retirement. So is she prepared to accept higher risk for greater reward, or would she rather keep her money safe and go for the lower return? We don't know much about Donna's ethical stance, especially with regard to those possible data breaches. That will be something to dig into if we could. We've been asked to make a recommendation on how she should invest her savings. If you don't give her clear advice, you're going to risk being stuck at level 1, which is a maximum of 5 marks. No right or wrong answer, but your advice must be justified. So you could say choose PIC PLC as it pays out significantly more in dividends, so income will be higher, and then maybe go on to cite a few other reasons why they should choose PIC. Or you could say choose Barnard as it appears to be growing fast and reinvesting profits, which could make for increased capital gains. Maybe throw into that conclusion a few possible downsides for each of them, but then just sort of come up with what you think is the overriding factor there that's led you to that piece of advice. You could even say split your investment between the two, one for income and one for growth. But I mean, this isn't enough. What I've put here on the slides is nowhere near enough for a justified conclusion. This is just kind of steering you in the direction you need to go. Okay, so the aim obviously is to get to level 5. So what you're looking for is a clear and balanced response. So clear means it's easy to read, balanced or well organized as well. A balanced response means that you've weighed up equal numbers of pros and cons, financial, non-financial, for each company, that presents a coherent and logically reasoned judgment, so it makes sense, and a conclusion solution that is supported by an astute consideration of a wide range of evidence, and that's everything that they've given you, including other factors relevant to the wider context. So that's your own knowledge, things that you know about the markets that these businesses are operating in. And there is insightful assessment of the significance and limitations of the evidence used to support the judgment. So these are the things we don't know about, the extra information that we could do with. So hopefully that's given you some ideas about how to get to level 5. It's just a reminder there about what you need to do in order to get up there. Types of connective words. So using connectives is really important. So building a chain of reasoning is one of the ways that you're going to get up that marking grid. So connective words are ones that link things to another. So we've got some examples here. There's a website that you can look at there, or just type into your Google or whatever search engine you use, just type in connective words, examples, that kind of thing. So I'm not going to go through all of this. I've done it before on previous videos, but it's all about comparing, contrasting, thinking about cause and effect. So if such and such happens, what will be the effects of that? What's the implication in this case for Donna? But that can apply to any questions that you do. So as I said, have a read through that. You can always freeze this screen and have a little look. And by all means, have a look at that study.com website for further ideas. So a few common mistakes that we want to avoid with these questions: generally, not performing calculations. That will restrict you to level 1, maximum of 5 marks. If you don't do any calculations, there are very few questions where there are no numbers involved. There have been 1 or 2, but really not very many. So make sure you do some number crunching. And then not embedding calculations in your writing is also going to pull you down to level 1. Weak evaluations of what those calculations show. So if you attempt some sort of evaluation of the numbers, then that's going to restrict you to level 2. Just regurgitating the source data without any development. If you've got large areas of text and when you're looking at how it's been marked, it's got no AO2 or no AO3 marks, you are probably guilty of this. So if your teachers have assessed, identified where AO2 and AO3 marks have arisen, if you've got a whole page with no AO2 or AO3 scribbled on there, probably suggests that you're just regurgitating the source data. Either that, or you've just gone off on a complete tangent and you're not answering the question that's been asked. Not showing a chain of reasoning or developing that would be, lots of AO2 marks, but very few AO3 marks. Not identifying the limitations, that's going to pull you down to level 3, a maximum of 15 marks, even if you do everything else brilliantly. If you haven't pointed out any missing information, limitations to the data, then that's going to restrict you. And then not giving clear justified advice, again, that's going to pull you down to level 1, maximum of 5 marks. So don't be that student. Make sure you don't run out of time and that you give some clear justified advice. If you think you are going to run out of time, if you're watching the clock and you're towards the end of the exam, then write a justified answer at the start, and then do as much as you can to justify that and to weigh up all the options. But just make sure that you give some sort of advice and make sure that it's justified. Okay, so hopefully that's given you some ideas about how to tackle this question. There have been a few others. We've had a question called Karoon, another one called Hannah. I think there's a video on Karoon. I'm not sure there's one on Hannah, but you'll see that they are quite similar, really, these investor ratio questions, and they can come up in either of the papers. So not just in paper 1, could be in paper 2 as well. But thanks very much for watching. If you've enjoyed the video, please like and subscribe.